Hello everybody! Today we're going to learn about a strategy called an iron condor, what it is and how to set it up. So what is an iron condor? An iron condor is a strategy that is predicting its days in a range, the stock price days in a range. So in this case you can see the stock price for the last few months has been essentially in this range. It's been between 175 and 140. So the assumption with the iron condor is that continuing forward for however long we have this trade, it stays in that range. So how do we set this up? I've already set it up for us. The stock price right here is essentially 148. What we're going to do is, remember we want it to stay below 175 and above 140. So the way we do that is we sell a call vertical with 175 as the short strike, meaning we want it to stay below 175 for this trade to be a winner. We made this a $5 wide vertical by buying the 180 at the same time. And at the same time, we're selling a put vertical, which means we want it to stay above our short strike, which in this case is 140. We're buying the 135 to make this a $5 wide put vertical. And that means as long as it stays below 175 and above 140, this trade will be a winner. And how much do we win? Well, when we sell this iron condor, we're going to collect $2.16. The most we can make on anything we sell is what we sell it for. So $2.16 is the max potential profit. But what's the max potential loss on this trade? And this may surprise you. So remember, max potential profit, which in this case is $2.16, plus max potential loss has to equal the width of the strikes. So the max potential loss has to equal 284 in this case. Because why? These strikes are $5 wide, and therefore if the most we can make is $2.16, in order for this to add up to $5, $2.16 plus $2.84 max potential loss equals $5. But you might say, well, hey Cal, we're selling two verticals here. We're selling a call vertical that's $5 wide and a put vertical. So shouldn't that be $10 as our width of strikes? No, because let's go with the extreme example. Let's say the stock ends up above 175. What happens? Well, this put vertical is a full winner and the call vertical is a full loser. So what that means is only one of these verticals, if things go against us, can actually be the width of the strikes, because if one is a full loser, which in this case would be the 175 call vertical if it ends up above here at expiration, that means the put vertical is a full winner. So again, we're only using one vertical as our width of strikes because only one of them can be a full loser at any given time. If it closed down below 140, for example, at expiration or whenever we close this trade, this call vertical would be a full winner and the put vertical would be a full loser. But again, only one can be a full loser. So $5 is the only width we're going to use because we're only using one vertical as our width of strikes. Hopefully that makes sense. A little confusing. But again, that is what an iron condor is. That is how you set them up. And that is how you work out profits and losses. And again, we can make this as wide or as narrow as we want. But we always want the stock price to be between the strikes. So in this case, if there's $5 wide strikes, the closest we could make this trade is we'd sell the 145 put vertical and the 150 call vertical, because the stock price always has to remain between our two short strikes. But we can go as wide as we want. We could make this 100, 200, 100 put vertical, 200 call vertical. It doesn't matter. But as long as the stock price is between our two short strikes, the strikes we are selling, this is a valid trade, and that is how you set up an iron condor correctly.